Canada's annual inflation rate ticking up to 1.9% in January, and measures of core inflation were also higher. Of course, this could raise the odds of the Bank of Canada standing pat on rates in March. Let's get some perspective from Thom, CEO and Portfolio Manager at Moat Financial. Chris, great to see you. Give us your reaction here. I mean, the Bank of Canada doesn't meet till March 12th. Do you think there is a real chance it'll hold off on the rate cuts for now?
Yeah, thanks for having me. I mean, we have been in the position that we at Moat, we felt like they started cutting rates a little bit too early. So it's not a big surprise that we're seeing inflation tick a little bit higher. There's just so many different factors, and I don't claim to be an economist. I don't work at the Bank of Canada. I've got the good position here that I can just come on TV and give my opinion on it. But we haven't seen a full cycle in Canada for decades. Where we saw the U.S. getting a full housing decline in 2008. I mean, we just kept lending, kept borrowing, and kept bidding those prices up, and the economy kept going. So, the Bank of Canada is in a real tricky spot to keep inflation down and keep rates low. So, we Canadians can enjoy these low mortgage rates that they've fallen in love with over the last few decades.
Yeah, that's interesting. And we have such an economy that's over-indexed to housing, don't we? Too much dependence, it seems, on residential.
Yeah, for sure. I don't have that number in front of me right now, but we are definitely a housing-dependent nation. And so if we see a decline in housing prices or a slowdown in housing starts, that's going to have an impact on the economy. But at the same time, if we look at inflation, the differential between interest rates in Canada and the U.S. has pushed down our dollar pretty significantly over the last 6 months or so, because the U.S. has not cut rates at the same pace as we have here. So, if we're buying goods from the U.S. that we buy in U.S. dollars, that's increasing in price for us as Canadians. So while we want to have rates come down so that people can afford things, at the same time, it's pushing up the cost of a lot of the things that we buy. So, like I said, I'm happy to sit where I sit on this one. But I think it's tricky to thread the needle on this one for the Bank of Canada.
We've got Delta Airlines down around 1% today. Miraculously, only 3 people apparently seriously hurt when that plane flipped over in Toronto. What are your thoughts on the airline stocks overall?
Yeah, so first, thank goodness there was nothing worse there. I mean, that kind of hit us hard here because we were in Toronto last week, and so seeing that take place, just so happy that nobody was more seriously hurt or killed. But the airline business, that's something that we just don't participate in. It's too hard of a business. Times get good, the economy gets rolling, and competition comes in. That's what the capitalist society is all about. And, that pushes down prices, squeezes profits, and makes it more difficult. Then on the other side of it, so when business gets good, it starts to get tough. And there's just so many factors that affect the airline business that can be so negative and have an abrupt, halt to things rolling. I mean, you've got, crashes, you've got global pandemics, you've got high oil prices, natural disasters, labor issues. I mean, there's just so many things that can make that business challenging. So, and very quickly, it can happen overnight. Just when you think things are going to be great next quarter, all of a sudden, sales drop by, a huge percentage. So, Delta's here, it's 12 times next year's earnings. By most measures, that would be something that we would look at for a business, but the E in that PE can disappear or be cut so quickly that, we're just going to leave this one for the next guy.
Give us your thoughts on the fertilizer names. We are expecting results from Nutrien this week. If there is an end to the fighting in Ukraine, it could increase supplies of potash and other fertilizers from Russia and Belarus. So presumably that could be bad news for NTR, although that stock, it has slipped in the past few sessions, but it's holding its own today.
So Nutrien, I mean, it was formed in 2018 with the combination of potash and agrium. Since then, I mean, there's been some really good times. We saw as COVID kicked in, we saw fertilizer prices rising and supply chain issues pushing up what these companies could sell for to a great degree. And then we saw the conflict in Russia and Ukraine, where the potash market specifically is really controlled by two cartels, if you want to call them that, Canpotex and coming out of Belarus. So when that one was cut off, that was really good for companies like Nutrien. We saw the stock get to almost $150. Well, the last few years, it hasn't been great. The stock's fallen about 50%. We are holders of this stock, and so this is a conversation that we have reasonably often with clients. But since 2018, the annualized return on the stock is only about 4.2%. So our view is that there's the ever-present thesis that the world population is increasing, and so we're going to need more food, and the only way to do that is to have more farmland or get higher crop results from existing land, and the only way to do that is through things like fertilizer. So the demand for fertilizers should be increasing, which should be good for a business like this, trading around 14 times earnings. So we do like it, but we are cognizant of the fact that there could be some pricing pressure on the products that they sell. So for us, I priced this out right when the market opened, and stock was around $72.50. So we're looking at kind of dampening any potential pullback on the stock. We don't want to sell it widely. So with the stock at $72.50 earlier, I think pricing is a bit better. Now we're selling the July $80 call for about $1.90. So what does that mean? That means if the stock goes up 10% from here over the next 6 months, then we're going to sell it. But for that, we're going to collect $1.90, which is about 2.5%. In addition, we're going to collect the stock's 3.7 yield, and then if the stock declines, we've collected a little bit of premium to sort of dampen that decline, and then we'll reevaluate in 6 months.
Right. Just give us a final thought. Maybe we could put up a one-year chart for the S&P 500. It's near a record high today. Toronto is not far off either. It looks as though investors around the world happy to take on risk and own lots of stocks.
Yeah, I mean, the markets have done really well, and they continue to do well. I mean, the S&P 500, as an example, is one that we see it as a very under-diversified portfolio with so much of it made up of just a handful of stocks. So there's definitely some risk there. If we see valuations come in or any hiccups in some of these large companies that are investing so much in AI, and that's got investors excited, I mean, there's definitely some scope for the index overall to come down because we see some compression in multiples on some of those specific names. But there's lots of good value out there, north and south of the border. So, we're here as portfolio managers investing in individual names, not the index as a whole. So I don't think you need to shy away from every stock just because there could be some pressure on the overall market.
Yeah, TSX still down from its high of January 30th. Maybe you can put up a 1 year for the S&P 500 and the TSX. Do you have a preference when it comes to Canadian or U.S. stocks?
So, I mean, for us, most of our clients are Canadian with Canadian liabilities. So, we would, if we could, we would invest everything in Canada. But we don't have everything here. There's sectors that we just don't have in this country. So for us, I mean, I've been on here a number of times, kind of beating the drum for the energy space. I think there's a lot of really good value there. I think I've had pretty much every major stock that we own has been a top pick for me at some point on here. So I didn't show up with one today, but I think that there's really good value in those companies. They're buying back their own stock. They're making lots of money. Some of this currency differential that I was talking about being hard on consumers can be really advantageous for those businesses. So yeah, I think you can look at that space for sure.
Thanks very much indeed for joining us today. We covered loads of ground. Chris Thom.
Yeah, thanks a lot for having me.
CEO